Welcome to the deep dive. Today, we're really getting into something crucial, mapping out retirement accounts. Think of it like getting the blueprint to build your own financial fortress.
Yeah, it's fundamental stuff.
Exactly. Our sources, they don't just explain things like 401ks and IRAs. They show how these tools, well, how they actually unlock financial freedom.
Mm-hmm.
So whether you're already dreaming of retiring early or maybe you feel like you're playing catch-up, this deep dive, it's your shortcut. We're covering smart strategies and, yeah, the traps you really want to avoid.
Good plan.
Okay, let's unpack this then. The big question first. Why even bother with these specific retirement accounts? What makes them a financial superpower?
Right, because you could just save in a regular account.
You could, but it's way more than just saving. Our sources point to two massive advantages: taxes, big tax breaks, and the power of long-term compounding. It's like exponential growth.
It really is. That compounding is where the magic happens over time.
Totally. Think about this example we found. Say you put $5,000 a year into a 401k. And let's assume, a pretty standard 7% annual return.
Okay.
In 30 years, that could grow to over $380,000. Now compare that to just putting it in a regular savings account, maybe earning 1% if you're lucky.
You'd be looking at, what, maybe $90,000?
Barely. Exactly. Barely $90,000. The difference is huge. It's your money working for you day and night. Plus, these accounts, they kind of force discipline, right? Building that saving habit.
That discipline point is key.
Yeah.
What's fascinating here is how this structure helps you avoid just frittering money away. It builds that habit automatically.
Right. Preparing you for when the paychecks start, beating inflation,
Yeah.
it covers a lot.
And the tax advantages just pour fuel on that compounding fire.
Mm.
But it's also true that each account type has its own set of rules, its own playbook.
Yeah, and that's exactly where we need to go next. Let's decode these different types, starting with the workhorse,
Yeah.
the 401k.
Classic employer plan.
Right. Offered through your job, usually.
Yeah.
You put money in before taxes are taken out, which lowers your taxable income right now.
An immediate win.
And the investments grow tax deferred. You don't pay tax until you take it out way down the road in retirement. But the real kicker,
The employer match.
the match, it's not just free money, although it feels like it. It's like an instant guaranteed return. Sometimes 50%, sometimes 100% on what you put in, up to a limit.
Yeah.
Like if you earn $60,000, contribute 5%, that's $3,000, and your employer matches 50 cents on the dollar.
They add another $1,500.
Exactly. $1,500 extra, just like that. That's a 50% return before your money even starts growing in the market. It's incredible.
You absolutely have to get that match if it's offered, leaving money on the table otherwise.
Definitely a top priority. Okay, so then we have IRAs, individual retirement accounts.
Right. For people who maybe don't have a 401k at work, or they just want another option, maybe more control.
Yeah, more investment choices sometimes. And here you have a choice, basically a tax choice. There's the traditional IRA.
Where you get the tax break now on your contributions, just like a traditional 401k.
Right.
But you pay taxes later when you withdraw in retirement.
Right. And then there's the Roth IRA. This one's kind of the opposite.
Pay taxes now on the money you put in, but then all your withdrawals in retirement, your contributions, and all the growth are completely tax-free.
Which can be amazing. Like our sources had this example. Say you're 30, you put $6,000 a year into a Roth, assuming that same 7% return.
Okay.
By age 65, you could have over $450,000, and it's all yours. Tax-free, no tax bill waiting for you.
That's a huge advantage, especially if you think taxes might be higher in the future.
Right. It's like locking in today's tax rate on all that future growth. Okay, quickly then, for self-employed folks or small business owners.
SEP IRA, Simplified Employee Pension.
Yeah, the SEP IRA, designed for them.
Yeah.
The big advantage here is much higher contribution limits, like potentially up to $69,000 for 2025, depending on income.
It allows business owners to really sock away a lot more for retirement. A powerful tool.
Definitely. And one more, kind of a sneaky one, but brilliant. HSAs, health savings accounts.
Yes, the triple tax advantage account if you have a high deductible health plan.
Exactly. If you qualify, you can contribute pre-tax money. It grows tax-free if you invest it, which many plans allow.
An IRA, yeah.
And then withdrawals are also tax-free as long as they're for qualified medical expenses, now or in retirement.
It's designed for healthcare costs, but many people use it as an extra retirement savings vehicle, especially for those future medical bills. It's incredibly flexible.
So many options, which kind of brings up the next point.
How do you choose?
Yeah. How do you decide which one or which combination is right for your specific situation with all these rules and benefits?
That really is the million-dollar question, isn't it?
Yeah.
It boils down to a few things. Your income level matters because that could affect eligibility for things like Roth IRA contributions or deducting traditional IRA contributions.
Okay.
Whether your employer offers a 401k is obviously huge, especially with that match we talked about.
The no-brainer part.
Exactly. Getting the full match is almost always step one. Then you think about your view on taxes. Do you want the tax break now, traditional, or later, Roth?
Right. And for IRAs, if you decide you want one, setting them up is easier now, right?
Oh, much easier. There are plenty of online brokers and robo-advisors. You mentioned Betterment, Wealthfront, places like that. They make opening and managing an IRA pretty straightforward.
Good to know. Okay, so we understand the what's. Now let's get into the how. How do you actually make the most of these accounts? What are the savvy strategies?
This is where the planning really pays off.
Absolutely. Strategy one, and we hear this all the time, but it's true. Start early.
Time is your greatest asset.
It really is. The power of compounding needs time to work its magic. We saw this stark comparison. A 25-year-old invests, say, $200 a month in an IRA. With a 7% return, they could hit over $500,000 by 65.
Wow. Just $200 a month.
Just $200. But wait until 35 to start seeing $200 a month. That final number drops by half to around $250,000.
10 years makes that much difference.
Double the outcome just by starting earlier. It shows procrastination is incredibly expensive. So the advice is clear. Start now. Even if it's tiny, like $50 a month. Just start.
Consistency over amount, especially early on.
Exactly. Okay, strategy two. Choose the right investments inside the account. A 401k or IRA is just the container.
Right, you need to decide how the money inside is actually invested. Stocks, bonds, mutual funds.
Yeah. And for people who feel overwhelmed by that, target date funds.
Those are often a great default option, especially for beginners.
How do they work again?
Well, you pick a fund with a year close to when you expect to retire, say a 2055 fund. Early on, it invests more aggressively, maybe more in stocks, for higher growth potential. Then, as 2055 gets closer, the fund automatically shifts to be more conservative, more bonds to protect your savings. It handles the rebalancing for you.
Kind of like investment autopilot. Makes sense. Okay, strategy three. Maximize contributions or get as close as you can.
Know the limits. For 2025, it's up to $24,000 in a 401k.
And $7,000 for an IRA, right? Or $8,000 if you're 50 or older. That's the catch-up contribution.
Correct. Now, hitting those maximums is tough for many people.
Totally understandable. So a practical tip we found was try to increase your contribution by just 1% each year. Maybe when you get a raise or just at the start of year.
Small increments. You might barely notice a 1% increase in your paycheck deduction, but over decades, it adds up significantly.
Definitely. And two bonus tips here. First, automate everything.
Yes. Set it and forget it.
Yeah.
Well, almost forget it. Set up automatic deductions from your paycheck to your 401k or automatic transfers to your IRA.
Takes the decision-making out of it each month. Consistency booster.
Absolutely. And the second bonus.
If you get a raise or a bonus, funnel at least part of it directly into your retirement savings before you get used to having that extra cash flow.
Lifestyle creep is real. This helps you prioritize saving before spending adjusts upward. It's a classic pay yourself first move. You know, if we connect these strategies, they're fundamentally about building good financial habits, not just making one-off decisions. Automation helps overcome inertia. Small, consistent increases leverage time. Funneling tackles lifestyle creep.
It's psychology as much as finance.
Precisely. It's about making the smart choice the easy default choice. Those small, consistent actions really do compound into massive long-term gains. It's proactive planning in action.
Okay, but it's not always smooth sailing. This is where it gets, well, maybe not interesting, but really crucial. What not to do. The common pitfalls.
The mistakes that can really set you back.
Mistake number one, and this seems to be a huge one, cashing out your 401k when you switch jobs.
Oh, yeah. So tempting sometimes. Especially if the balance isn't huge yet, but such a bad idea.
Terrible idea. You get hit with income taxes immediately, plus usually a 10% penalty if you're under 59 and a half.
And the biggest cost, often overlooked, is losing all that future tax-deferred growth. Decades of compounding, just gone.
I remember reading about someone who did this repeatedly and later calculated the lost potential. It was staggering. Millions lost.
Painful. The solution is simple, though.
Right. Just roll it over. Roll it into an IRA or sometimes into your new employer's 401k if they allow it. Keep that money invested and growing tax advantaged.
Don't touch it unless it's an absolute emergency, and even then, explore other options first.
Good advice. Okay, mistake number two. Ignoring fees.
This one's sneaky because fees often seem small, like fractions of a percent.
Exactly. But those little expense ratios on mutual funds or the administrative fees in your 401k plan, they add up year after year. They eat into your returns silently.
You need to know what you're paying. Check the plan documents, the fund prospectuses. Look for low-cost index funds or ETFs, where possible.
What's a good rule of thumb for expense ratios?
Oh, aiming for funds under 0.5% is a decent start. Lower is generally better, especially for broad market index funds where costs can be incredibly low, like under 0.1%.
Well, pay attention. Keep more of your money working for you.
Absolutely. Fees compound too, but against you.
Right. And finally, mistake number 3. Setting it and forgetting it. Completely.
Wait, didn't we just say automation is good?
We did. Automation for contributions is great, but forgetting it means never looking at it again.
Ah, okay. So don't neglect it entirely.
Exactly. You should check in maybe once a year. Just review your investments. Are they still aligned with your goals? Has your risk tolerance changed? Maybe you started aggressive, but now you're closer to retirement and want to dial it back a bit?
Life circumstances change. Maybe you got married, had kids, changed jobs again. Your financial plan, including your retirement portfolio, should probably adapt too.
Right. So automate the saving, but don't abdicate the oversight. A quick annual checkup keeps things on track.
It's fascinating, isn't it? How these seemingly small things, cashing out early, ignoring tiny fees, not reviewing annually, can have such enormous long-term consequences.
Huge impact.
It really drives home the need for vigilance, for being proactive. It encourages you, the listener, to really be an active participant in steering your own financial ship, not just a passenger hoping for the best.
Well said. Okay, so let's try to wrap this up. The core message from our deep dive today seems clear. Retirement accounts. They're your ticket, your pathway to a secure future.
They really are powerful tools.
And they work best when you do 3 things. Start early, invest wisely inside the accounts, and stay consistent.
Simple principles, but incredibly effective over time.
And if you need specifics, like the latest contribution limits or detailed rules, reliable sources like the IRS website are your best bet.
Always go to the official source for those numbers.
And for help with planning or managing accounts, we mentioned apps like Empower or platforms like Betterment, Wealthfront. They can provide tools and guidance.
There's lots of help available.
So as we finish up, maybe a final thought for our listeners to chew on.
Okay. Beyond just hitting a savings number, maybe take a moment to reflect. What does financial freedom actually mean to you personally in retirement?
Interesting. Like, what does it look like day to day?
Exactly. Is it traveling? Yeah. Pursuing hobbies? Not worrying about bills? Having options? And then think about how understanding these accounts, the 401ks, the IRAs, the HSAs, how does that knowledge actually empower you to build that specific vision?
Connecting the mechanics to the dream.
Right. Because mastering these accounts isn't just about accumulating wealth. It's about gaining control, options, and ultimately, the peace of mind to live the retirement life you truly envision for yourself. It's about funding your future.